Before we begin, a quick disclaimer. This podcast is for entertainment and information purposes only. It should not be relied upon as a base for any investment decision. Nothing here is a solicitation or an offer to buy or sell any security. Either the host, guests, or clients of either may own securities discussed on this podcast. Welcome to the first edition of the Special Situations Report. We have a very special guest today. It's Jeremy Raper of Raper Capital. And let's get Jeremy in here. Hi, Jeremy. Very welcome.
Hey, Bram. Thanks for having me. It's great to be here.
No, it's my pleasure having you on this first edition. First thing I wanted to ask you is to tell us something about yourself. Like you've worked, I think, on the buy side and the sell side, and you've got an interesting background that includes stints all over the world. So I was curious if you could tell us something about that.
Sure. Okay, I won't make it too lengthy or boring, I guess. I grew up in Sydney, Australia, so I'm Australian by birth. But I left Australia as soon as I finished high school. So I've lived basically, in many different countries since then. So I went to university in the United States. Then I lived in Japan. So I kind of began my career as a financial markets professional in Japan from 2008, working on the sell side. So I was doing credit and equity derivative sales for a large bulge bracket firm based in Tokyo. So I kind of lived in the US, then I lived in Japan. And after that, when I moved to the buy side, I moved back to New York for a year and change. That was kind of how I moved from the sell side to the buy side. And then after that, I moved to Singapore for, family reasons, lived in Singapore for a few years. And then now finally I live in London. And most of those moves have been dictated by buy side jobs or my wife's jobs. So yeah, at this point I've kind of lived a little bit in Europe, a little bit in the US, a reasonable amount in Japan, and obviously mostly Australia, but I haven't lived back in Australia since I was, 18. So it's been about, 16, 17 years. So it's been quite a while. And actually I think we might move my family back to Asia very soon once the coronavirus, issues are resolved. That's kind of what I'll be doing.
Okay, and it's just because you want to be closer to family, or because you want to be safer, maybe?
No, yeah. Well, definitely closer to family. The safety issue is, look, we'll figure it out or we won't as a species, right? So I'm not sure it makes a huge difference if you're in Asia or Europe once we have the vaccine. Basically it's a family move. And also I'm sure we'll talk about it later, but since I left my last buy side job a year and a bit ago, and I'm now doing this new research business, I have a bit more flexibility on location. So given that I am Australian, my wife's actually Japanese, so it makes more sense for us to be in Asia. But yeah, looking forward to doing that, and obviously getting my business up and running as well.
Sure, because you just launched Raper Capital, the research service. I actually followed you throughout the years on your blog and the things you write about, and I think I would love to talk about your ideas that you have.
Sure.
You just launched it, and I think it's a very detailed research into both longs and shorts, and it's a little bit aimed at the institutional or high net worth individual, right?
Yeah, that's right. Look, I'd say it's a little different to your typical kind of research service, right? Because in two regards. One is the perspective. So, you're a regular reader, so you kind of know that I look at things from more like a creditor's perspective or a creditor's background. So essentially that means I really try to underwrite the downside much more than the upside. I care about getting my money back a lot more than I care about, say, the growth or the 5-year growth potential of a given investment. Even though I apply that mentality towards stocks. So it's definitely kind of a value bias, but even I would say a modified value bias where I care very much about kind of the credit worthiness of the underlying corporation, and try to isolate what the true sustainable free cash flow of the given investment is, and how that cash is coming back to me. So that's kind of, sorry, you were saying?
Yeah, if I can interrupt you for a second, there was something really cool I've heard you tell before, and that's that you actually watch for covenant breaches in companies, and that's like a catalyst for a change in the value of the equity. I thought that was very original.
Thanks. Yeah, no, that's a key part of looking for catalysts on the short side, right? So a lot of people, so obviously I do longs and shorts, right? So I try not to take overt market risk. I try to hedge my longs and my shorts and try to make money throughout different market environments. And so on the short side, what I've found over time is a really powerful catalyst can be not just a violation of, say, credit covenants for a levered company, but actually just the threat of the violation of credit covenants. So when a company comes close to needing to go to their lenders and ask for forgiveness or ask for a waiver of debt covenants, that alone can often be, many times actually, that alone can be enough to catalyze a huge downward move in the equity price for a levered distressed entity. So Bram, you're in Holland, so you're in Europe, so you probably read the Financial Times frequently. It's very common in English companies, or I guess let's say London listed companies, where the FT, look, they won't be deep in the weeds on the credit of a given company, but they'll be, reporting on the various levels of distress. And so they'll, last year before Thomas Cook went bankrupt, you saw many headlines in the newspaper where the byline of the newspaper article was Thomas Cook comes close to breaching debt covenants, and the stock would be down 30-40% on that news. I mean, a more recent example is Aston Martin, right? One of the failed IPOs from last year, stock priced at £16 in the IPO. It was extremely levered. They had some funky accounting going on where they were really capitalizing a huge amount of their expenses as R&D development. Quite unusual for an auto company. That aside, they were too levered coming out the gate. They were burning a lot of cash, and they ran into trouble with their covenants. And as soon as that became public, they didn't even trip them. They eventually tripped them, but before they tripped them, once it became public that a covenant breach was on the table, the stock fell 40% in a day. So there's a huge amount of power in finding these credit catalysts and using them to re-rate equities on the short side as well as the long side. The long side is a little trickier in the current environment just because credit is so available. So for example, if we are going back 10 or 15 years and a company was upgraded from high yield to investment grade, that used to be a really powerful catalyst for reflecting on the equity value, because being high yield or IG, there'd be a big difference in credit cost, right, for that kind of company. These days, that's not the case, right? There's very little continuum of credit curve between, say, the bottom IG ranking and the top high yield ranking.
Yeah, in an absolute sense. Sense, sure.
Exactly. So there's not as big a look through implied, cost of equity re-rating potential on the long side. But, that comes and goes with the credit cycle. But nevertheless, on the short side, you see these examples every day where, levered companies come close to violating covenants, and it's a huge catalyst for re-rating a stock on the downside. So it's a very important thing to look for. But just kind of tying it back to what you're asking about the research that I do. So the perspective is that of a creditor. And then the actual output of that research is, as you said, it's very kind of deep dive, fundamental, company specific. It's not really macro oriented. Of course, I'll make some implicit macro bets given the company or the industry, but it's very much deep dive fundamental on company specific theses.
Right. Yeah, it's hard to avoid macro bets at this moment.
That's right.
Yeah, definitely. You're very, in principle, you're very bottom up focused, and
that's right.
Very detailed analysis. I think we'll. At the end, I'll ask you about your where people can find you, but you have some freely available materials and people can check it out, and it's how detailed it is. Super interesting. Hey, I wanted to talk to you about a few of your ideas that I think listeners of this podcast might be interested in. And I want to start it off with you've been talking about a company, I hope I pronounced it correctly, Aerocap Holdings.
Yes,
and
yes,
I think it's a great example of a company that's probably very interesting from a creditor's perspective. There's a lot of leasing involved, a lot of debt involved there, and it leases aircrafts to airline companies.
That's right. Yeah.
And I think I'm right if I say it's sort of it has been like a favorite of hedge funds for a couple of years, and then it sort of fell out of favor.
Yeah, I think that's right. I mean, yeah, definitely. It's Aerocap is the world's largest aircraft leasing company. So essentially what they do is they buy aircraft from Boeing and Airbus. They tend to not buy them in the secondary market or from airlines. They tend to buy them directly from the OEMs, the original equipment manufacturers. They tend to buy them many years in advance, right? So they'll give a big order, say, an order for 100, 200 planes, and they'll be delivered over a number of years, 4 or 5 years. And in return for that, they get a big discount from the OEMs. They take those planes, they turn around and they find airlines and they lease them to airlines on, the typical contract will be maybe 10 to 12 years for the first lease.
Are they currently ordering? Because I think they can get big discounts.
Exactly. So actually, they're not ordering. No one's ordering right now. In fact, everyone is trying to defer deliveries. Basically, they're asking for delays from the OEMs. So, this is not unique to Aerocap. This is every lessor in the world is trying to do this, and every airline in the world is trying to do this. So in a normal environment, we'll talk about Corona shortly, but in a normal environment, this is kind of the business model. They are essentially a financing company where they will finance the delivery of new aircraft for an airline, and in return for that, they'll be paid, on a monthly lease rate factor for the rent of the airplane over 10 to 12 years. Then at the end of that first contract, you'll get the plane back from the airline, and you'll have to find another airline to take it essentially for the rest of its life. So a typical aircraft can generally be in service for 20 to 25 years, closer to 25 years, depends on the operator. So essentially you need at least, say, 2 long leases to cover the depreciable value of the aircraft. And so this business makes money if the rate at which they can lend out the aircraft is high enough to A, cover the depreciation cost, and B, cover the financing cost, because as you said, they're levered. And so they make money on the net spread, the difference between what they charge the airline minus the financing cost, minus the depreciation cost, and then obviously minus the credit costs, because not every airline makes it. And that the difference, hopefully, of all those is a positive number. And that's essentially your return as an investor, as an equity investor, right? So the interest cost goes to the debtors that builds out the debt that funds a lot of these planes. And then the equity level return is left at the end of all those takeaways. Yeah. So it's a very simple business model. It's actually grown rapidly. So, air travel's basically gone up over the last 30 years, air travel's doubled every 15 years. Absent the current environment, it's basically been a one-way trajectory. And aircraft leasing has also been a growth industry, right? So, in the early 1990s, it was maybe, I want to say 10 to 15% of total aircraft were on operating leases. Today, it's closer to 40%, maybe north of that. And it will probably go to above 50% post this crisis, because one of the big takeaways of the environment is airlines will be in much more distressed balance sheets coming out of this crisis, and therefore they won't even be able to afford to buy their own planes. So they'll have to rely more on leasing going forward.
And I think it's a little bit of like a cost of capital arbitrage, right? Airlines tend to have sort of high cost of capital, and because these are sort of reliable income streams, they have low cost of capital, and it's better to have it in separate vehicles. Or is that about right?
Exactly. I mean, that's one of the main points is cost of capital arbitrage. So it's, obviously the airline business is highly volatile. Not even just forget now, but in a normal period of time, if oil is $50 or $100, it can destroy your business, right? That variation. So the airline P&L is extremely volatile, whereas the leasing P&L is much more regular. You get the regular monthly, essentially, rent checks for the airplanes. And Aerocap has 200 customers worldwide. So, even their biggest customers are only 5-6% of their revenues. So, even when you do have credit losses in a normal environment, they're not that large relative to the total asset pool. So you're right, it makes sense from a financing perspective, but a lot of aircraft leasing happens within proper banks, right? So one of the largest lessors in the world that's doing well right now is called Bank of China Aviation, which is 75% owned by Bank of China, and obviously benefits from Bank of China funding costs. Similarly, Japanese banks have large leasing operations because they have structurally low cost of financing. So that's a huge advantage, right? If you can borrow at 50 basis points, 1%, and then earn, gross spreads on your aircraft of, 8%, 10%, let's call it 10% gross rents, and then 8% somewhat net before depreciation. That's great, right? Whereas, Aerocap, even before this environment, was financing it, say 4.5%, let's say 4%. And that's about as good as it gets for a non-bank affiliated aircraft lessor.
And is this like an industry bet for you? Do you like the entire industry? Because I hear you mention some competitors, what do you like specifically about this one?
Yeah, so I like the business model. I've liked it for a long time. I'd say I like this company specifically, and I like maybe one other company as well. It's called Airlease. So that's AL. But I mean, there's, obviously, like any industry, there's the haves and the have-nots. So if we kind of divorce the current environment at the moment, we put that to one side and look at what the business used to look like, or in a normal environment it looks like. There are two main risks, right, with this business. One is credit risk, so your customers go bust. And the second is residual value risk, right? So when you get the plane back at the end of the first lease, are there too many of those planes in the market? Do you have to take a big write-down? Because at the end of the first lease, you still have over half the value of the plane left, or let's say half the value of the plane left. If it's a 25-year life, you get it back year 12, there's still a huge amount of value left there that you're taking risk on. So those two main risks, how do you actually defray them? Well, the number one way to kind of minimize them is, one, if you're the biggest, you have the biggest book of clients, so any given default doesn't affect you as much. That's one, diversification. And obviously that leads into the second as well. If the biggest risk is residual value risk, other than credit risk, then if you have 200 plus clients, you have the most opportunities to move those planes around when they come back to you, because you have the most information. Aircraft leasing, aircraft trading is not like trading Microsoft shares. It's not a transparent market. So the fact that you're the biggest, you do the most transactions, gives you the most information, that gives you an edge. And we see this as
occasionally there's like I think there's like vehicle trading on the London exchange, which is like one plane, something like it's trading at a deep discount. There is. I think there are maybe 3 of those. It's like closed-end funds. I think
you're talking about Doric, right? Doric Nimrod.
Yeah. I think they're called something like that. But they have like one plane, so that's pretty dangerous.
Yeah. So those ones are. Look, there's a few things going on. Doric Nimrod is a closed-end fund listed on the London Stock Exchange. They were launched to acquire a bunch of A380s.
Okay.
That are owned by Emirates.
Sure.
So that you have two problems. One, you take
that's
one
like Middle Eastern airplane.
Yeah, exactly. So Emirates, sorry, they're not owned by Emirates, they're leased by Emirates, right? They're leased from this special purpose vehicle. So if you buy this special purpose vehicle, you own a share in these planes that are on lease to Emirates for X number of years. And then at the end of the life, Emirates has the option to either buy the plane or return it to you, and then you have to do something with the plane. So the argument for those assets is they're trading at such a big discount that even if Emirates gives you back the planes at the end of the lease, there's no residual value being implied in today's stock price. So you could then turn around and someone's going to buy those planes. The problem is the A380 is basically a dead plane. There is no demand. Okay. And so look, there may be some residual scrap value, but there's such an excess supply of that particular type of plane. And the reason for that is it's a double decker. No one needs double deckers. Wide bodies in general are kind of out of favor. And within wide bodies, the Boeing Dreamliner is by far the main new technology aircraft. That and the A350. The A380 is just way too big. When you go park,
you really need to get lucky with some kind of up-and-coming Richard Branson who will buy it off your hands, maybe something like that.
Maybe. Okay. I mean, look, it's trading at a level where you can make an okay return, even if the A380 just goes to zero at the end of the Emirates lease. But I mean, you also take some risk that Emirates defaults, right? Mm-hmm. Of course, Emirates is a very good credit because it's owned by the Abu Dhabi, the UAE government, but look, there's lots of airlines that were almost state-owned that are now in trouble, right? So it's not a perfect credit.
Hey, then,
So
Jeremy.
why would you take that risk when you could own Aerocap and
Mhm.
you have 200 different airlines that are backing your claim essentially?
Yeah, and now we're talking about risks already. So I thought with Aircap, it was like the perfect stock to ask you about what do you think about the reopening, because this one has like one of the most macro risks among your ideas that is most
Yeah.
dependent on the economy and doesn't really have like a key driver, like an event that drives the value. So I was curious what are you thinking about where we're going?
Yeah, well, I mean, on the one hand, you're right. They are sensitive to an airline start operating again. On the other hand, it's a very long dated asset, right? So if the reopening happens now, if the reopening happens in 6 months or 9 months, I mean, of course, I would prefer for AirCap's perspective, it happens sooner than later. But as I said, these are kind of 10, 12-year contracts, and a lot of them are getting extended. So you're not really betting, at this stage, you're not really betting on the airlines reopening tomorrow and they're making a ton of money, because everyone knows even when they reopen, they'll still burn money for a certain period of time. Essentially, the bet you're making with AirCap now is how many of their customers are going to go bust, right?
Mm-hmm.
Are many of their customers going to go bust? And if they go bust, how many of them are going to reject all their leases? That's the real risk bet you're making. So I think actually it's a bit different. If you were rushing out to buy, say, Air France KLM stock or American Airlines or even Deutsche, Lufthansa or something, so some of these
I'm
actual operators,
not rushing out.
no, not many people are, but in the US, a lot of people are speculating on American Airlines, Delta. Those were very levered to the reopening trade, and are trading more on sentiment
Mm-hmm.
than actual underlying earnings. AirCap trades at 30, 35 cents on the dollar in terms of book value. So and has basically proven they don't have any liquidity risks for over 2 years. So to my mind, all they have to do is stick around for a year. And even if the world returns to some normalcy, some semblance of normalcy, it's not going to trade at 35 cents on the dollar. Sure, they're going to take losses here and there, of course. But the right price is more like 60 cents on the dollar in an environment where we're just, in a bad economic environment, right? Where, this
Mm-hmm.
thing used to trade at book value or close to book value. So we can have a long, complicated discussion about the residual value of the aircraft they own if you like.
No,
But I think
that's fine.
I think the price, why you buy it now at 30, 35 cents on the dollar is because you think this is just going to re-rate well above half of book if they just stick around. And since it's highly likely they stick around for at least 2 years, the risk reward here is still highly compelling.
Cool. Well, thanks for that. Then maybe the next thing to talk about that's pretty interesting is there's a company called International FC Stone, I think. Did it
Yes.
pronounced
Yeah.
correctly? And
I
it's
think yeah, it's FC Stone International.
FC Stone International. And that's a recent idea of yours, and you're excited about it.
Yeah,
And
I love this company.
okay, and it's financial, and they do a range of things, right?
Yeah, so this is a bit of a complex animal in terms of the operating business. So first of all, the ticker is INTL. It's listed
Mm-hmm.
in the US. I think it's the Nasdaq. It might be the New York Stock Exchange. But anyway, it's listed on
Yeah,
the US. The market.
I'll list all
Yeah,
the tickers beneath this podcast so people can easily reference
perfect,
the companies we're talking
perfect.
about.
Yeah, it trades about $5 million a day. So it's not the most liquid stock in the world, but it's liquid enough for most small investors or even small funds. So this company is a diversified financial services company. Essentially, it's a roll-up. It's a roll-up of different small broker-dealers and commodities-related businesses. So the core of the business is actually in physical commodities hedging. So they used to do, well, I mean, they still do, a huge amount, I think it's about a third of their profits come from intersecting or trading with actual commodities producers, not just
Mm-hmm.
oil or your typical kind of commodities like aluminium or coal. Also soft commodities, they'll deal with farmers, they'll help them hedge their products, and that's kind of the original core of the business. But over time they've stapled on these other businesses, that have diversified the offering. So now, for example, they have a payments processing business. It's about 15% of earnings. They have a securities clearing business. They also have quite a small retail brokerage business offering, FX, stocks,
Sure.
and they have, go on.
Do they have like a high insider ownership? It's like an owner-operator present here that or because you often see that with like these smaller investment banks like Jefferies or BC
That's a great question. I actually don't know off the top of my head what the insider ownership is, so I don't want to speculate. I can look it up and maybe come back to you. You can put it in the notes.
Okay.
But I guess the point is, look, why is it interesting? So the main reason is they're buying another company called Gain Capital, GCAP, and they're buying it at an insanely low price, and no one's really paying attention. So they've agreed to buy GCAP at $6 a share, when GCAP, by the time they close the acquisition, tangible book will be around $9 a share. Now, the reason they're getting it at such a huge discount to tangible book is, Gain Capital is another one of these retail brokers that offers contracts for different CFDs. And before Corona, volatility was very low. And basically the way these things operate is when volatility is very low, it's very hard to make money because no one's trading. No retail punters are trading. But when volatility explodes, a huge number of people rush back to the market and trade. And because the spreads widen out, you make a commission on each trade. You also make money on the spread. And you also lend money to these guys, and often the retail guys take a lot of leverage. So it's a very profitable business. And the cost base is almost the same, right? So it's huge leverage to increase in activity.
And this is like, I think this is super interesting because it's a very rare asset that actually benefits from like volatile times in the stock market. I mean, usually you have to buy options like puts to profit from times like this, but this is like you can make a long bet on something like this, and you have like a positive carry and that unique feature. I love these assets.
That's a great point. I mean, that's a great point. The point is exactly right. You get paid a positive. Well, I guess you're not really taking a dividend out of it, but in a sense, you're getting paid a positive carry because book value is accreting so fast.
Yeah, but there's not I'm not actually sure with this company, but usually they're not like sustainably losing money until times like these, right? They're doing okay in normalized earnings.
Okay, so FC Stone, yes. So on a normalized basis, FC Stone made 82 million in net income last year, and pre-COVID, they made $20 to $30 million in pre-tax income on a quarterly basis. So you're right, they're sustainably making some money. So to put that in perspective, the current market cap today at $51 is about 950 million. So it's trading at about 10, 11 times pre-COVID earnings, normalized. So not a high price, but it's about just over 1 times book, a bit north of 1.1 times
it's
book.
Not unusual in the financials.
Not unusual. Doesn't look incredibly cheap. But when you adjust for the Gain acquisition, you're actually getting into this company well below book value. I think about spot 9 times book value and around tangible book. And the key point is there's a huge amount of excess capital coming with Gain. So because Gain, last year Gain Capital lost money, and then they decided to sell the company at basically tangible book value earlier this year. But since they decided to sell the business in February, and now Gain has already earned over 110 million in EBITDA. Now they sold the company for 225 million. So essentially you've bought it because a lot of that EBITDA turns into cash, depreciation is very low. They have some nulls. That's about 100 million of cash. 115 million of EBITDA turns into 100 million of cash. So effectively, the purchase price went down by 50%, or close enough to 50%, purely in the last 2.5 months of excess earnings. So, look, there's a bunch of Gain Capital shareholders who are agitating for an increase in the offering, increase in the price from 6 to say 8 to 9. I think there is some chance the price gets bumped in the next week. So the vote is this week, actually. The vote is June 5th. because they do need to make sure the deal gets through. But as part of the acquisition, they already locked up 44% of the shareholders to support the deal. And for whatever reason, management of Gain is acting very strangely. They don't want to try to negotiate for more money. Look, it's a very strange situation. I'm also long Gain, to be honest. I'm long Gain, also long Intel. So I think both will do well. I think Gain could get a bump.
Bigger on one side or?
Oh yeah, I'm bigger on Intel. I'm bigger on INTL because I think most all the value will derive to them. So for example, if they do increase the price from $6 to $8, or maybe $6 to $7.50, that incremental increase is still only $40-50 million. And if you look at the deal deck, they are saying that deal synergies are in year one alone are 21 million. But I actually think that's massively understated because, both these companies have offices all over the world. They overlap. There's over $100 million of regulatory capital you can take out of the business very quickly. So that 21 million, that's way understated. So even if they have to give back 40 million or whatever, that's not even 1 year's worth of, it's maybe 1 year's worth of synergies. Plus they got all that extra 120 million of earnings, right? So it's still a great deal. So the long story short is if you properly account for a conservative look at what GainCap can provide, not based on Corona numbers, right, which are crazy, way too high volatility. If you properly account for what GainCap could provide in a more normalized environment where volatility comes down but doesn't go all the way back to 2019 levels, and then you just run the synergy numbers, not aggressively, but basically with what the company's told you, which again are too low, you're buying INTL at 6 times earnings. Not only are you buying it at 6 times earnings, you're buying it 6 times earnings and they have a ton of excess capital when no one covers them, right? So there's only incremental upside from coverage when the balance sheet will be extremely clean within a year because of that excess capital. And when returns have never been this high, right? So they're going to print mid-20 ROEs versus long-term averages around 12 to 15%. And you're buying it at 6 times earnings and around book value, less than book value. Now the stock's rallied a little bit, but I mean, what would you pay if you thought ROEs were sustainably 20%? It's a financial asset. It's not over-levered. And they have a more diversified business. You'd clearly pay closer to 1.5 times book than 1 times book, right? So to my mind, look, I wrote this up when the stock was 39.40. The stock's now 50. I could easily see the stock being 70 within 6 months, maybe a bit longer. But essentially, my 1 year forward numbers, I think the stock's worth between 65, 75, 80.
Sure. And again, the catalyst for you are just financials coming out. People will recognize the earnings are there and
exactly. The catalyst is the pro forma earnings. So everyone's looking at this as if it's just INTL without GainCap.
I mean, because there's not a lot of coverage, maybe it takes a while, but then the financials come out and screeners will pick it up, algorithms will pick it up.
Exactly. Maybe it takes 6 months because no one covers it, but they're going to print 150 million of net income at the end of this year. Well, more than that, but on a normalized basis, let's say 130 to 150 million of look forward net income they're going to kind of talk about. And last year they did 80. So, if it was trading at 10 times 80, why couldn't it trade at, at least close to 10 times 130, 140, right?
Is any chance Gain just walks away? Do they? Is there a penalty or? So won't do it.
They probably would have walked away by now if they're going to walk away because the vote is in 4 days. All the signs they're making suggest they're just tired. They just want to get this done. Basically, as I said, 44% of shareholders committed to vote at $6, even though the stock today is $6.30. And they, recently
so
they did
actually losing money on the Gain side if it doesn't get a bump.
Exactly. Sure. I am. Right. Yeah. I'm willing to take the risk that, the 4-5%, draw down to $6. But I do think there'll be some token bump, but I just don't think it'll be $8. I think it might be $7.50 or something.
Yeah. But if you lose on the Gain side, you'll make it up on the international side.
Exactly. And that's why my INTL position is bigger. And actually that's going to be, it's a meaningful position for me. It will be a core position for me if they do close the deal once the vote goes through. Then I will really size up the position aggressively. Okay.
Cool. Maybe in the interest of time, because I don't want to keep you too long, let's. This, is a super interesting idea. check out Jeremy's site for more. Maybe West Shore Terminal is an interesting
West Shore
short idea for you, and it already worked out really well. But it's still, I think it's still very interesting. And it's a secular, sort of a secular decliner is coal terminal.
Yes, West Shore. Okay, so West Shore terminals, as you said, they ship coal from a port just south of Canada. Well, from a coal shipping terminal just south of Vancouver, I should say, on the west coast of Canada. This short I first wrote up at about $21 a year ago, maybe. It's now
Canadian or US?
It's Canadian, so it's listed on the Toronto Stock Exchange.
So
it's about a
21 Canadian dollars. Sure.
That's right. 21 Canadian dollars, and it's now about 14.50 Canadian dollars.
Sure.
I think the market cap today is about 900 million Canadian dollars. So it's not a huge company, but it's not a tiny company. So Bram, everything you said is correct. I mean, it's a one asset company, so that they literally ship coal from this terminal. That's it. It's a very simple business. They get paid based on loading rates. So if they load 30 million tons of coal a year, they get paid this roughly, $10 to $11 per ton, depending on the client. And if they load 20 million tons in a year, then it's the similar amount per ton, and therefore there's a huge amount of operating leverage up and down, because essentially all the costs are the same. Whether you load 20 million or 30 million, you can't fire a third of your people just because loading goes down, and obviously all the depreciation of the equipment, that's all the same. So it's a very high fixed cost business with huge operating leverage, as you can probably imagine, given the fixed costs. Now, this is great when volumes are steady, and it's terrible when volumes are not. So the main issue with this company is, historically, it used to be a very good business, but it was very concentrated. So over 60% of their volumes come from one customer, and that's Teck Resources. Resources.
Sorry, how many of the volume did you say?
60%.
60%. Okay, that's a lot.
That's right. So I think Teck had a contract to do 19 million tons. I should be more accurate. It was 19 million tons a year coming from Teck, and they were doing high 20s. So it was about 60%. Then they expanded capacity to the low 30s. So Teck's share went down a little bit. Not that important, because they fully reliant on Teck. Now, there's two key points here. One, obviously huge customer concentration. Two is that contract actually runs out in March 2021. So they have less than a year left of that contract. And since that's upcoming, Teck has been moving very aggressively to move away from using West Shore. They've been committing CapEx dollars to develop their own terminal, which is located in the same harbor, just a different part of the harbor. That's a facility called Neptune. And then they've also signed a contract with another competing terminal called Ridley, which is quite a fair way away, and just recently got sold by the British Columbia government to a private ownership. And we think, well, I think they did that deal at very attractive rates, because Ridley was being underutilized.
Yeah.
The key point.
Sorry, no, we're just getting to a key point, so please.
Yeah. I mean, the key point is, when close to 60%, call it 55, 60% of your volumes are going to move away, there's very little you can do to replace that. And, it's not, I mean, it's a done deal at this point. If you follow the West Shore filings, they say, they lay it out in black and white that volumes from Teck will go down substantially from 2021. Now, maybe that doesn't mean to zero immediately, because there'll be a ramp period at Teck's own facilities. But this decision has been a long time coming. Teck's committed hundreds of millions of dollars in CapEx to build out Neptune.
And something that really jumped out at me when I looked into this company was how hostile Teck really is, because a contract that expires is not always a big deal. So sometimes people renew it, or maybe Teck is growing a lot of coal volume, a bit unusual in this environment, but who knows? But they're really pissed off, sort of pissed off at West Shore. So that's what I thought was very unusual and very interesting, maybe.
Yeah, well, what happened was Teck is met coal, metallurgical coal used for steel production.
Mm-hmm.
And the rest of West Shore's clients are essentially thermal coal used for electricity generation.
Yeah,
Thermal coal.
met coal is like the highest quality and it's
Exactly.
more expensive.
Met coal. Exactly. Met coal even today trades above $100 a ton, and thermal coal trades at $50 a ton. So the problem was West Shore was commingling some of the coal in their facilities, and that was making it more difficult for Teck's customers when they took delivery of the coal in Asia to get a better product. And the other main complaint they had was that West Shore was prioritizing thermal customers in terms of throughput instead of met coal, which is hugely damaging to Teck's P&L, because if coal prices spike very rapidly, and they do whenever there's if there's a big hurricane or typhoon in Australia, met coal prices can just take off. There's a huge amount of excess value if you get your coal on the ship at the right time, because your customer in Asia is paying a spot price when the coal gets loaded, when they take delivery of it, which is essentially when it goes on the boat in Canada is when the contract gets written, right? So, the difference between, hundreds of millions of dollars, it's not an exaggeration to say, coal sitting in a warehouse beside the terminal for a week because of delays can cost Teck tens of millions of dollars. That's a statement of fact. So that had been happening over and over, and this is one of the motivations why why Teck wanted to insource their own terminal, to try and capture the margin and prevent that from happening. But the other main reason was West Shore just kept on jacking the rates higher and higher over many years. So, if you compare the average rate that Teck is paying, which is around $11 or $12 a ton, and look at the rate that gets charged for coal loading in, say, Australia or on the east coast of the United States, it's a fraction of that, right? In Australia, it's less than half of that. In the east coast of the United States, it's definitely much less than 10, 11 a ton. And look, obviously there's regional differences. It's a more captive market, but Tech's saying this is ridiculous. We should be, if we insource our own terminal handling, we can do it for half the price.
Yeah, but I think if it was just like a pricing problem, just a threat of building a competing facility, they could probably work something out. That's how this sometimes works. It's also very, it's powerful to have an asset like this, but I think those relationship got really screwed up. So that's super interesting. And the catalyst is early 2021.
Well, look, I mean, exactly. There's a few things going on. So the West Shore, the Teck handover will probably happen in early 2021. But I think the main catalyst is actually well before then. I think the main catalyst is probably sometime in the second half this year or very early 2021, because they have to announce the go forward plan or the go forward contract. They're not going to wait until March 2021 and say, okay, that's done. Normally it happens, in advance. So it could happen any day. But the other problem for West Shore is the rest of their customers are all going bankrupt. So, if it was just a Teck renegotiation issue, that would be bad, obviously. But the other 40-50% of their customers are all thermal, and thermal coal exports are completely uneconomic at current prices, most of them. Most of their North American customers are either in deep financial distress or filed. And most of their key customers, so for example, Cloud Peak Energy is an old thermal coal miner in the PRB that had one mine that shipped Kalimantan, Indonesian grade thermal coal through West Shore for Asian generation markets. They're $15 per ton underwater at the mine head right now. And the company went bankrupt and got bought by the Navajo Nation. It's very unclear if the mine even stays in operation. I mean, that asset alone was meant to provide over 10% of West Shore's volumes from this year and going up, right? They were meant to increase production. So you have all these kinds of problems. You have Single Peak, another producer, having issues. You have Coalspur, another asset, having issues, and all the greenfield production that was meant to come online to replace things like Teck going down in volume. A lot of these things haven't got permitted, or the market environment has changed. So there is a real risk, to my mind, that West Shore has to repurpose the terminal, or at least half of it. So, and that's going to cost a lot of money. Let's say they said, we're not going to do 30 million tons of coal. We're going to do 20 million tons or 15 to 20 million tons, and then we're going to do lumber instead. they're going to have to spend a boatload of money to repurpose half the terminal. And obviously the financial earnings power of the business are going to fall off a cliff.
Yeah.
So the stock's down, 35% or whatever, but I think it's a much better short now because going forward, I mean, I think this thing trades north of 30 times free cash flow on what real sustainable free cash flow is from next year.
Sure, yeah, and it's sort of amazing because I watched like Canadian TV, and there's like asset managers coming on shows like CNBC, and they're talking about like some temporary headwinds and like as if this asset isn't impaired, and it's just crazy. Yeah, maybe it was a little while ago, so maybe the last disclosure they've seen that, but I was like, are they not even reading Seeking Alpha? Because
I think I think the answer is yes. They're not reading Seeking Alpha. The main problem is that this used to be a very good business, right? And it used to be a very steady business for many years.
High dividend.
The high dividend, no debt, right? Steady, dependable business. So that's problem one. Problem two is the main shareholder, this guy James Patterson, owns 25% of the business. He's a very well-respected Canadian investor. I think he's a billionaire, has a very good reputation. So I'm not sure he's the Canadian Warren Buffett, but he's one of those types. So it's not as if the Canadian sell side brokers want to go against him. And the other problem is it's just undercovered. The guys that cover it are mostly infrastructure guys. They're not mining guys. They're not coal guys. Anyone that covers coal knows that, a lot of these mines are just structurally, a lot of these mines that feed the terminal, they're just structurally screwed, for want of a better word. And like you said, it's basically an impaired asset at this point, and we're just waiting for tech to fully move away to prove that. So yeah, it kind of looks cheap, right? It trades at 9 times earnings historically, but it's really trading at 30 times earnings forward, and it's a coal terminal. So at this point, look, I really like it because I'm not sure, absent some massive unforeseen rally in coal, which you can hedge, by the way. You can buy tech, you could buy some levered coal producers as a bit of a hedge. I have a very small position in a couple of coal names as kind of a hedge. It's very hard to see how
super cheap too. So
yeah, exactly. You can buy high quality coal producers at 3-4 times historic free cash flow. Versus selling this at what I think is excess of 30 times go forward free cash flow.
Yeah.
That's kind of the trade I have.
Hey, Jeremy, do you have a little bit of time left? I don't want to keep you if you need to get back to some business or. But
no, I have another 10 minutes or so if you want to look at one name.
Well, let's do one last name. It's Neo China. You've written a lot about it, and I think it's super interesting. Short position.
Yeah,
sure. It's known as the Tesla of China, sort of.
Neo, yeah. Look, Neo. Maybe it takes more than 10 minutes to explain.
Well, we can try to.
I'll make it very brief, maybe. What do you think?
And people can read more. I think there's a lot of free articles on your blog that people can read.
Yes.
I don't know if you recently written about it behind paywall, but.
I think all the Neo stuff is free, so most people can read about it. But you're right; it's called the Neo of China, as the Tesla of China.
Sure.
I'm not sure exactly what it has in common with Tesla, other than being an electric car manufacturer.
But they make it they started with like the higher end. I think that's why people use it and not.
Sure. Well, I guess look, if you just look at the P&L, so Tesla, of course, hasn't made much money. They've reported a couple of profitable quarters. Who knows how sustainable that is? But at a very high level, at least Tesla generates a gross profit, right? So they sell their car for more than it costs to make the car.
Yeah.
Neo sells their car at a negative gross margin, right? So for a fundamental principle, if you're making a luxury brand, and apparently this is a luxury car product, how can you sell it at less than what it costs to make it and claim that there is any brand value? That's the part I don't understand. So look, last year they sold just over 20,000 vehicles in China. This year they're doing a lot better. There's apparently demand coming back. They're probably going to sell, I think they'll probably sell 35,000 cars this year.
I mean, I think it's fair to say that it's like unit growth, but since the IPO, they are burning cash every quarter, and they're like slashing costs like pretty hard.
Exactly.
I think there were a
Exactly.
few instances where they didn't pay employees in time that were
Yes.
reported in the press, and they're showing all signs of like financial distress. Is that fair to say?
That's absolutely correct. They are showing unit growth while they're burning prodigious amounts of cash. So
Mm-hmm.
they last year they burnt, I think, close to $1.5 billion US dollars.
Mm-hmm.
And you're right. They issued a number of very dilutive debt deals. They essentially, what they did is they started issuing deep in the money convertible bonds.
Yeah,
So
because
normally when
they're out of cash, so they need to raise money, and they usually need to raise it. What I would think is on very desperate terms, but Jeremy's like, he knows how desperate.
No, you're right, Bram. You're right. They're pretty desperate terms, but it seems like the retail investor doesn't agree because the stock doesn't go down. But yeah, essentially, an in-the-money convert is kind of a very toxic form of financing because it's highly diluted, right? So if your stock is trading at 350 and you have to sell an in-the-money bond, an in-the-money convertible bond with a strike of $3, essentially what you're doing is you're giving a debt claim to the guy who buys that paper, but it's already deeply in the money. So they get all the upside if the equity, just stays where it is. They get this balloon upside, but if the equity ever goes down, you still have to pay them back. So it's like the worst of both worlds. If you just sell common equity, sure, you dilute yourself. But if things stay bad, you don't have to pay that back because it's equity.
Yeah.
What they did is they sold a bunch of deep in the money converts to fund the ongoing operational burn in the business, whilst also not paying their employees and their suppliers.
Right.
But yeah, I mean, the game goes on.
The coupon on the convert looks pretty low, and that's why maybe people think, oh, this is not a big deal. But if you buy the convert, and I think this is a game that a lot of like specialized hedge funds play, is that they buy the convert and sell the equity, right?
That's right.
And then you get a risk-free return that's pretty high.
Yeah. So look, there have been a number of these deals. So the most recent deals, I think they did 435 million of these converts in the last 3-4 months. They all came with a 0% coupon. 0% coupon, right? So like you said, it looks like it's free financing.
Mm-hmm.
But the way you get paid as a convertible arbitrage hedge fund is as you said, you buy the bond, and it's at the same time you buy the bond, you short the stock. And so if you think about it this way, if you're buying the bond with a credit claim and you have the stock say 350 or whatever, 360, and you have the immediate right to convert it with a $3 strike price, then as long as you short the stock at the current level, or near the current level, 350, 360, you can lock in an automatic risk-free profit. So, if you're locking in 60 cents on a $3 stock, let's say, 60 cents on a $3.60 stock is about 20%. Essentially, what that means is the cost of financing for the company is 20%. Forget the 0% coupon. The real cost of financing is close to 20%. It's actually higher than that. I won't go into why.
Yeah.
But yeah, so apparently the real cost of financing is huge. It's very distressed level. Now, what's more interesting recently is those convert deals were not enough. They needed more money because they're still burning huge amounts of cash. So they had to take a rescue financing from the local government in China, Hefei. The Hefei is a province in China. They essentially took in 7 billion yuan, which is about $1 billion. So it's a lot of money. Well, it's about 1 year's worth of cash burn. So it's not actually that much money, but it's a lot of money at an absolute level. And in return for that, they gave 25% of the China business to Hefei. So NEO, the current NEO holding company, which is an offshore holding company based in the Cayman Islands, will be left with a 75% stake of the China business. Hefei comes in, gets 25%. So a lot of people look at this transaction and think, oh, wow, that's great. Outside investors paid $1 billion for 25% of the China business. Therefore, the whole thing is worth $4 billion, right?
Mm-hmm.
No, they don't read the fine print. So I went into this on my site. It's freely available if you look at my site. Essentially, what happened is two things happened. One, this new money is coming in at NEO China, the operating company level, right? that new money will only come in after all the assets, all the operating assets of the business are transferred into this new entity. And the claim being given to the new money is not the same as the normal equity claim. Yes, they'll own 25% of the equity of the new company, but they'll also have the right to a guaranteed 8.5% annual return for 5 years. And they'll have the right to foreclose on the asset if it hasn't gone to an IPO within 5 years and is not in the process of being IPO'd within 4 years. So essentially what they're doing is, again, it's kind of like a bit opaque, but they end up with an equity stake in the business in the upside case, but in the downside case, they have a debt-like claim. They have a liquidation preference, right? So they have the right to foreclose on all the assets if Neo Inc. doesn't commit their capital, if they don't, abide by all these other terms and restrictions, and they have a minimum guaranteed return of 8.5%, which is basically what a bond is, right?
Sure,
it's like a bond.
And I think what we'll speak to people is that like there's all this convertible debt and a little bit of other debt, and that is staying at like the Neo holding level that trades in the United States, right?
Yes,
and,
exactly. That's the exact key point, that the only things being transferred into the new co are assets, not liabilities. All the financial issued at Neo Inc., which is the Cayman Island level. Mm-hmm. So what you're left, if you own shares in Neo today, yes, you're right, you have a 75% stake in the assets, but you still have 100% of all the financial liabilities. So the look-through valuation is actually terrible for you, because even if you think that the Neo China assets are worth $4 billion, which I don't, but if you did, you own 75% of that. Okay, great, that's $3 billion, but you still have over $1.5 billion of debt and growing, right? Which needs to be paid back. So the actual enterprise value, look-through enterprise value, is really only $1.5 billion. Yeah. Today, the stock trades at a $4 billion market cap. So I don't understand.
Yeah, I would really hated this if I were long. But you started shorting this around what price would you say, or what market cap is maybe better in this?
Yeah, no. So I think I started shorting it around $5, $5.20, something like that, about a year ago. It went all the way down to $1.30, $1.40. Yeah. And now it's back at $4. So I mean, look, I've actually, to be honest, I've lost money on this because I added the short at lower prices. So it's been frustrating, but it's that kind of market where people don't care about fundamentals. They only care about unit growth, even though that unit growth is really destroying value. And in addition to the value being destroyed through the business, now you're seeing value being destroyed through restructuring and asset stripping, which I thought more people would care about, but apparently not so far.
No, but I think I've probably lost money on it as well, because it's very hard to trade. It's maybe a good warning for people who think, this sounds like a great idea. It's super volatile, and for me, it doesn't trade the way I would expect. Like, I remember one day where it went up like something like 90% in a single intraday, like within a day. So it's not for big positions.
Exactly. It almost doubled in a single day. And what was crazy was that was the day then their accountants put a note in their report saying that they might go bust. So it was the same day where they said, we think the company might go bust in 12 months, was the same day the stock almost doubled.
I guess it was good news because they weren't bust yet, or...
I mean, that was the conclusion. Obviously, I didn't see that coming.
No, I remember the day. I think, sales is growing a little bit, so that's interesting. But actually, Tesla is ramping up production in China, so it'll be interesting to see how all that plays out. I want to wrap it up here because we've been talking for an hour. Cool. Jeremy, thank you very much. I loved having you on. Or maybe let me just check my notes if I wanted to ask you something specific. Let's just leave that for another time.
Okay.
Thanks so much for coming on. And where can people find you and read about all these super interesting?
Sure. Yes. Thanks for having me. So if anyone wants further information on me or these ideas or how to kind of get my research, they can go to rapercapital.com, R-A-P-E-R capital.com.
Sure.
You can also follow me on Twitter. It's a good way to reach me. At PUPPYEH1 is my Twitter handle. And look, if you just go to rapercapital.com, you can find my email address and all that as well. And so I'm always happy to talk with potential investors and subscribers if you have any questions on my research or the service. That'd be great. Thank you.
Cool. And if I'm right, if you like infrequently publish on Seeking Alpha?
Yes. I mean, I definitely used to publish a lot on Seeking Alpha. It's a bit more infrequent. I obviously have a profile on there, so you can find me on there as well. These days, though, through the site or Twitter is the best way to.
Cool. Well, thank you very much, and we'll leave it at that.
Thanks a lot, Bram. Much appreciated. Speak soon.
Okay, cool. Okay, I think I'll let me see if I can pause the recording.